Trading for a Living by Dr. Alexander Elder. So he starts off the book by basically telling you that psychology is the key to trading and that your emotions can actually kill your account and that you should be aware that the market is always against you. And he gave the analogy how germs used to kill people way back in the day before they knew they even existed. And just like germs kill your account, slippage in trades and commissions kill your trading account. Slippage is basically overpaying for a stock, like 30 cents being paid for an apple that was only posted at 29 cents per an apple. And that the market is not a zero-sum game like everyone thinks it is. It is actually a minus-sum game because of slippage and broker and commission fees. There are three basic kinds of slippage. There's the common kind, which is the bid-ask spread. There's the criminal kind, where you basically buy bad stocks versus them. And then there's volatility-based, which is the increase and fluctuation of the bid-ask spread. So you want to avoid those kind of trades, and you want to be in the most liquid markets as possible, but also avoid fast-moving markets. Use limit orders when selling and buying your stock, and go long or short in quiet markets. He suggests that you keep a journal and write down all your trades and study yourself as best as possible and as detailed as possible. He then goes over that you should not risk more than 2% of your account on a single trade, and that the professionals say that 2% is too much while amateurs assume that it's too little, and that the best traders make trades in quiet times and sell during the wild times. There are three kinds of trades in the market. There are the bulls who buy and hold. There are the bears, who sell and sell short, and then there are the undecided who wait it out, and each person has their own place in the market with their own effect. But always remember, when you trade from home, you're the one that gets the news last. The crowds will follow the crowds. Your job is to take the news and analyze it and determine what should happen. And keep in mind that stocks rarely rally really hard after a bad decline. He gives the example of, imagine if a man fell 3 stories from a window. It'd be almost impossible for him to get back up and start running. However, if he fell down just a few stairs, it'd be easier for him to get up and start running again. A common thing is that people try to convince themselves of their own beliefs, whether bulls or bears are controlling the market, and that you need to actually be impartial when deciding. You want to trade with the professionals. He then goes over what a support and resistance line is, and how when a stock starts getting to a support that it might start to break through it, and if that's the case, you need to tighten your stop loss orders, and that weekly support and resistance line are more important than daily support and resistance line. And that to not just place your stop orders on a round number, place the orders where you actually see the support and resistance line, even if it is a weird number. True breakouts are confirmed by high volume, not small volume. Professional traders get out of losing trades and they get out of them fast, and that the waiting area for a pullback is an amateur's game. But if you have to wait for a pullback, at least just do 1/3 of your 2%. And then when it starts to pull back, you can go ahead and do another 1/3, but don't do it all at one go. When you have all your charts set up, one of them is going to be wrong. One chart may signal a buy, one chart may signal a sell, but the professionals look at the bigger pictures. So don't be too concerned on the 5-minute charts and the 10-minute charts. Draw trend lines through areas of high volume and congested areas. You don't really want outliers. With those trend lines, if there's an uptrend, look to buy. If there's a downtrend, look to short. And when you see a reversal coming, get out of your positions fast. There are 5 key things to look for: time frame, length, the angle, volume, and how many times it touches the support and resistance lines. The more accurate and the more valid the line, it's going to be on the bigger charts, not the smaller charts. Make sure to measure the angle of the trend line to see how strong either the bulls or bears are in control. Remember, volume represents the activity of these stocks, and professionals know analyzing volume is key when trading these stocks. There are 3 ways to analyze this: the actual number of shares or contracts traded, the number of trades that took place for the day, and the tick volume, which is the number of price changes during a selected time. Falling volume gives a sign that a trend is about to reverse. Professionals don't hold on to losing stocks, they get out fast. So when the volume starts decreasing, more than likely the professionals are already out of the trade. High volume means the current trend will continue, and time is crucial when trading. Some things to keep in mind is that the 12 to 18 months after an election tend to be the most bearish, and the 2 years before an election tend to be the most bullish. He then goes over his triple screen trading system on how on one screen he's going to have the weekly charts, one screen he's going to have the daily charts, and his third screen where he's going to have all his trading taking place. Remember, most breakouts are actually false and followed by reversals. Emotional trading is the enemy of success, and when you lose 8% in a month, remember to stop trading and examine yourself and determine what you're doing wrong. And whenever you're using indicators to buy into a stock, use those same indicators to tell you when to sell out of a stock as well. Review each trade and self-analyze yourself as a trader and as a whole. That was the main gist of the book. In my personal opinion, it was a pretty good book. It did get into the psychology of it too, even though I didn't really mention it too much. It talked about how trading could be like the waves, like when there's a wave, there's also a ripple. Follow the wave, don't follow the ripple, and he equates that to like daily charts. Like the wave is like the weekly trend, the ripple is like the little 10-minute or daily charts to look at. And clearly he's writing this book, he doesn't really outright say it, but he's writing it as a day trader. A lot of these rules and psychologies relate to day trading, especially since he's doing technical analysis. He doesn't care about the fundamentals of a company at all and the psychology behind it, since you are trading on the mindset of the crowd, because this is a day trading community. You're trying to compete kind of with one another, and how slippage and all this little things are a major concern for day traders. So the main takeaways I'll talk about from this book that he recommends is you have to be smarter than the crowd, but understand what the crowd is doing. Commissions and fees and all those little things start to add up. When trading, follow trends. Don't try to fight the wave. Understand volume and how when volume's increasing, whoever is in control, whether it's increasing as in a massive sell-off or a massive buy, know that's who's in control and that's the crowd you should follow. Whenever volume is decreasing, the stock is going to come back to a rest and you don't want to get in that stock anymore. That's a reversal, so get out as soon as possible. Never risk more than 2% of your account when day trading. And you'll notice that whenever stocks have a huge jump up, it's because of based off of news, but it seems like that news just came out and the stock already jumped. Remember, you were the last one to get the news. So with those stocks, I would say get in and get out really quick. Either way, it was an enjoyable and interesting book to read. I hope you guys like the book summary. Leave a comment in the comment section below which books you would like to see next. Thank you guys for watching. Remember to leave a like, comment, subscribe for more future content.